Inflation appears to be cooling a little. Data from the Labor Department shows consumer prices rose 7.1% in November. That's from a year ago, down from 7.7% in October. Food and energy prices remain high, however. For more on this, William Lee joins me now from Los Angeles. He's the chief economist for the Milken Institute. So, William, why did inflation go down in November? Or I should say, sorry, slow in November?
That's exactly right, John. Energy prices have come down a bit, but unfortunately, food and vegetable prices continue to be above 10% from a year ago. And inflation really is unacceptably high relative to the Fed's target of 2%. And inflation, as you know, is the cruelest tax on people. It affects people disproportionately, especially the low income and lower skilled people.
And William, why is it so sticky? I mean, so this is better news than expected, which is a bit of a change because usually inflation was exceeding the expectation and the guesses. So this is under the guesses. So I guess that's an improvement. But as you say, it's still out there. What's your assessment of why it's been so persistent?
Well, in this economy, goods prices tend to move fairly rapidly and adjust to supply and demand conditions. But service prices are incredibly sticky, especially shelter costs. When our leases renew once a year, and we see that the new leases that are being renewed are coming down at not going up as quickly as before. But on average, shelter costs remain fairly high, and especially the way the BLS calculates the inflation numbers, it's going to take a while for the new leases to kick in and bring the average cost of rent and housing for the average consumer down to more acceptable levels. So service prices is really the area where the Fed is most concerned. And Chair Powell told us that wages themselves, because of the tight labor market and shortages in various sectors, are keeping wages rising at a very, very high pace, about 5.5%, 6%, which is way above what the level that's consistent with 2% inflation.
2% inflation being the target that the Fed shoots for. So the Fed's meeting this week. What's your expectation?
Well, the Fed is going to give us a message that they're not going to give up the fight. Even though inflation appears to be moderating, it's way above where it needs to be. And the Fed will continue its tightening, although it'll slow down the pace of tightening. Instead of raising interest rates by 0.75 of a percentage point, it probably will raise rates by, say, 0.5 percentage point and give us some indication as to where they think rates are going. And I think right now, the committee, the FOMC, the Federal Open Market Committee, is fairly convinced that we need rates somewhere around 5.5%, perhaps even 6%, to cool the economy down. Because the one thing that will stop inflation is that people will stop spending. And right now, because of the tight labor markets, the high wage increases, people are having a lot of income to spend, and they're not moderating their spending. And so if people are concerned that the economy may slow down, unemployment rates may go up, they may get laid off, perhaps people will start to ease up on their spending.
And William, as a final question, a lot of economists and those who pay attention to the market are thinking that there might be a recession in the next year and have different views about the amplitude of that recession. What's your opinion?
Well, I think the most important thing for our viewers out there is that this recession may be very different from the previous recessions we've had, where unemployment rates rise by more than 2 percentage points. Millions of people get laid off. Right now, we have vacancies that are way above the number of unemployed people. And the Fed is hoping that we can moderate the pace of growth and the number of job openings will go down instead of the number of unemployed people going up. And that would be one way of easing the labor market.
So, okay, wonderful. Thank you. William Lee, we appreciate you being with us.
Thanks, man.